Joining us today is Brandon Munro, the CEO of Bannerman Energy, following the publication of the Etango-8 definitive feasibility study, and that is, of course, the 95% owned uranium project. So welcome onto Stopbox, Brandon. It's good to be talking to you. How are you?
I'm really well, thanks, Mark. Thanks for having me on.
Well, thank you very much. Of course, you're calling from Namibia, where the project is, so you're right at the heart of the action. I wonder, before we get into some of the detail on the DFS, could you just start by perhaps giving a little bit of background, just a little bit of background on the project generally for people who are perhaps not familiar with it?
So the Etango project in Namibia, it's been a large-scale project that we've been working on since 2005. Its attributes are it's a very simple bulk tonnage heap leaching operation, and it's a large deposit. It's over 200 million pounds of resources, and we're looking to develop it at a throughput of 8 million tonnes per annum to produce 3.5 million pounds per annum of yellow cake, which is about enough to operate 7 to 8 gigawatts of conventional nuclear power.
Okay, excellent. Well, of course, the DFS was released just this week, which is very, very good to see. That's always a good point in the company's history when the DFS comes out, puts some real concrete numbers around it. And things I noticed from the DFS was, first of all, the confirmation, both technical and economical viability of, as you say, the open pit and heap leach processing operation. With an estimated 8 million tonnes per annum throughput, which gives an NPV of the project of $209 million US, which really does underwrite the company's market cap, doesn't it, there at about $250 million. I wonder if we can talk a little bit on the uranium market, because of course the DFS talked about the base pricing of $65 per pound of uranium there. That generates that $209 million. But there's also the upside case, isn't there, of $80 million. So, sorry, 80 US dollars per pound. And that would generate the value of 436 million. So what's the uranium market looking like? And I mean, you must have your ear to the ground. I know you were attending the one of the forums, I think, in London not so long ago. I saw some videos you posted. What is the general feeling about the uranium market and where it's going, and how realistic that upside pricing potential is?
Well, you're right. I am very privileged to have my ear on the ground. For 4 years, I was the co-chair of World Nuclear Association's demand working group. So that was the body that was forecasting, or still does forecast, nuclear fuel demand and therefore uranium demand out to 2040. And that goes into World Nuclear Association's flagship publication, the Nuclear Fuel Report. These days, I serve on the advisory panel of World Nuclear Association. So that, and the fact that we invest very heavily in understanding the market as a company. So uranium, first of all, is still coming out of a bear market that was quite a protracted bear market after the Fukushima accident in 2011.
Yeah.
Uranium prices dropped as low as $18 a pound at their absolute depths and have recovered significantly, and they're trading in a range of around $50 a pound at the moment. So that is the spot price. Over time, the long-term contract price has traded on average at a premium of 10 to 20% to the spot price. And it's a long-term contract price that would form the backbone of the price assumption that we'd put in the DFS. So as you can tell, it has some way to go yet before we would be ready to start pushing the button on contracts. And we, as your audience would understand very well, Mark, it's at the point where you start locking in those contracts that you start to crystallize the shareholder return that you would obtain. So we'll be very careful about that, applying our nuanced understanding of the market to ensure that we enter the market at the right time. Now, in terms of the broader market and your question, the prospects for nuclear power are exceptionally strong at the moment. And I've been in this sector actively as an executive since 2009, and in my professional background before that, I was quite involved with a number of uranium company clients. But even when I talk to industry veterans, they'll tell me that this is the most buoyant they've seen the sector in 30 years, possibly longer. And that's reflected in the way that policymakers have abruptly changed in a more positive way their stance on nuclear power. And that's been brought about largely because of COP26 and now COP27 and the focus on decarbonising at a time when some of the limitations of intermittent renewables are becoming better understood. And it's more recently, the focus has come back onto nuclear power because of the war in the Ukraine and all of the associated energy security issues that are becoming into plain sight because of that. Now, what we face at a uranium level is, so nuclear power looks very strong going forward. And at a uranium market level, there's still a significant supply deficit. So the amount of uranium that's being consumed in nuclear reactors around the world every year is significantly more than the amount of uranium mined.
Okay.
Now, in recent years, that deficit's been made up predominantly from two different sources. First of all, secondary supplies, and but predominantly the drawdown of inventories. So either loose inventory or mobile inventory that's available amongst traders or other market participants, or in the case of utilities, many of them bought more than they really needed after Fukushima because they honoured long-term contracts. And they've been working off those excess inventories. Now, interestingly, both of those sources of supply to meet that deficit have now dramatically increased. And so the primary deficit, the difference between what's consumed and what's produced, is now coming into real focus over the next 12, 24, 36, 48 months in this sector.
Okay, I noticed you commented in the the news release that $80 per pound would be necessary to incentivize sufficient production across the industry. Do you think that makes? Why would you say that? You think because it makes it very attractive to get into uranium production at that sort of price?
Well, the first thing, Mark, is that that's not just a thumb suck. That's not a guess on our part. We, going back as far as 2016, when I came in as CEO of Bannerman, we extensively modelled the entire sector. We modelled all of the nuclear demand and worked with different scenarios about the increased deployment of nuclear reactors. We modelled nuclear reactor closures, and we paid particular attention to the supply side and new projects that come on. And that's when we first realised that $80 for the scenarios that we worked with was what would be required to naturally produce the additional production that's embedded in the current sector. So Cameco can expand, Kazatomprom can expand, but that's not enough. So then you need a price that's going to bring on the latent production, the mothballed mines, the restarts, but that's still not going to be enough. So then you need a price that'll bring on the new projects, including our Etango project. And when we look at the number of pounds or the number of annual production pounds that will be required this decade, and we start to rank the projects that we believe can come on stream, we think that incentive price is going to need to settle around $80. And this market is known for overshoots, so there'll be the potential above that. So there's a lot of science behind that figure that we've used in the DFS. And as I mentioned, through that modelling and through my involvement in industry, I then had the opportunity to be very involved on the demand and supply side through World Nuclear Association's Nuclear Fuel Report. So that's our belief, and that's what our corporate strategy has been driven towards since 2016. And that's why we think that an $80 price is an appropriate comparison. Okay. Now, of course, a lot of investors can apply a higher price target than that. There are a number of very positive scenarios for the uranium price, but we felt that those two alternatives gave continuity of numbers from the PFS and the scoping study at $65, but also gave investors, particularly investors who are already on Bannerman's register, the opportunity to interrogate the project against $80 a pound.
Indeed. Well, of course, shareholders or investors can, of course, draw their own conclusions looking through the numbers in the DFS. It's a very lengthy document, as you would expect from such a study. The table there clearly sets out lots of different figures there and, the value case. And I want to just pick up on the life of mine as well, the initial 15-year operating life of mine that came from the DFS. And that is actually scalable, isn't it? There's long-term scalability here that could take you from that 3.5 million tonnes per annum production to 20 million tonnes per annum, which would effectively double the NPV. So can you let us know a little bit more about the scalability of this project?
Yeah, I'd love to. And for people who are new to the Bannerman Energy story, there's a little bit of the history that I should probably fill you in on. So as I mentioned, we've been working on this project since 2005. And for the first decade or so, we believed that the best way to bring this mine into production was at the largest conceivable size. And that 20 million tonnes per annum that you referred to, we took a development pathway at that rate all the way through to definitive feasibility study in 2015. Now, that Etango-8, as we call it, that would have produced 7.2 million pounds per annum. So an enormous uranium mine. And frankly, after Fukushima, it became too big for the market. And it also had a capital cost that became too big for our market capitalization during a bear market. So in about 2019, we looked at alternatives and we found out that at the smaller scale of 8 million tonnes per annum, not only did it reduce capital costs and had a number of other benefits, but the economics actually improved because the stripping ratio was so low. Now, the benefit of all of that work that was done for the first decade or so on this project is twofold. First of all, it made the current DFS a lot lower risk than you would normally have, in the sense that we've already done the work at a larger scale. So it made this job a lot easier. But it also means that we have a very good understanding of what an expansion could be. Under that 2015 DFS, we had an ore reserve or a mining reserve of 130 million pounds, compared with the current 15-year ore reserve of about 60 million pounds. So we absolutely know the ore is there because we've done to a definitive level a project that in 15 years was going to mine about double what this 15 years is. So that gives you a high level of assurance that, for example, it would extend from 15 years to 30 years. What it also means is by doing a definitive feasibility study at that 20 million tonnes per annum, we've got a very good feel for what an expanded production case would be. So we know that once we're in production and profitable at 8 million tonnes per annum, that's producing 3.5 million pounds. Around year 5, we'd need to make a decision. Do we decide to increase the scale of this production essentially in a modular way? And if that was the case, then we would then start investing in a bigger cutback to open up more ore. And whether that was 20 million tonnes per annum or 16 million tonnes per annum, that's something that we would decide closer to the time based on where the market was at, how much support we had for additional long-term contracts, and of course, what makes the most sense. So that scalability is really quite unique in that way. And just to remind everyone, so the ore reserve for Etango-8 is about 60 million pounds. Now we've got a mineral resource upwards of 200 million pounds, and we have 2 additional satellite deposits within very easy trucking distance as well. So I think the best analog here, Mark, is the Rossing uranium mine, which is just down the road from us. When that started in the 70s, it started with a 16-year mine life. Now, 45 years later, they're deciding whether to extend for another 10 years. And we think that this ore body would probably behave in a very similar way. We know that the ore continues at depth well below the 130 million pound ore reserve pit shell design. So we would expect that this could be a decades-long mining operation here.
Excellent. Well, that sounds very good, and that's a good little comparison for people to look at. Another point from the DFS, of course, was that Namibia has the 45-year uranium mining and export history, currently the world's 3rd largest supplier of uranium. So you're in a very good jurisdiction there for operating in uranium. Now, moving towards financing and construction. It's a very good stage to be at, but of course it does take capital to do that. And an estimated capital expenditure of $317 million will provide an attractive upfront capital cost of approximately $90 per pound, and then that will drop to that $38 per pound as you get into production. So what are the plans to finance this? I know we've just got the DFS, it's a big milestone out of the way, and I'm immediately on to the next big element. But any initial thoughts on getting this to construction status?
Yeah, of course. We've obviously been working quite extensively on financing, because there isn't a lot of point investing in a DFS if you don't believe it's financeable. And mid last year, we engaged a debt advisory firm out of Sydney, and we've been basically establishing the base case financing. That's a conventional financing that's bringing in syndicated lenders. We've got a good feel for who would be willing to lend to uranium, who would be willing to lend to uranium in Namibia, what their requirements are. We've done an extensive exercise in understanding what their ESG the requirements would be. We've undertaken a gap analysis there to make sure that the long lead item environmental and social boxes, they can all very easily tick. So we're confident as to what a base case financing would look like. And that would be financed much in the same way as any other commodity, except that we would need to have long-term contracts in place because of the way the uranium market works. Now, we do think, Mark, that there's potential opportunities to create shareholder value over and above that base case financing. And that's because of the very unique structure of the uranium market as it interacts with the nuclear fuel industry. But what you've got here is you've got an enormous capital investment in nuclear reactors. And the comparative amount of capital to feed those nuclear reactors with the same amount of uranium that they consume is very, very small. So for that circa $320 million investment in Etango, that would be enough uranium to service 7 to 8 nuclear reactors, which have each been built at, let's just say, $5 billion each. So that presents some very unique opportunities for, first of all, offtake financing, but also other arrangements with nuclear utilities where they realise that using the finance that they can achieve with their balance sheet makes life a lot easier for us. But of course, it gives us a much better cost of financing, which increases shareholder value. And you've got hybrids in between that. Because of the nature of our sector, because of its strategic importance, its multilateral importance with recent political events, we expect export credit agencies to play a much bigger role. And there's certainly some interesting hybrid scenarios between sovereign financing or large-scale nuclear industry financing, various models between that and a conventional financing that you might consider for a copper mine.
Okay, so potentially then, just as an example, an energy company looking to start a new nuclear plant could indeed factor some of their cost of the supply of uranium to power those plants from your deposit in their process of actually commissioning and building their plant.
Yes, it is more complicated than that. And when I say we could service 7 to 8 nuclear reactors, no nuclear utility in their right mind would allow themselves to be entirely dependent on one mine for that. But that's how the math works.
So the math works. Okay. In terms of just thinking on timelines, it's very difficult to think on timelines, but of course, building new nuclear plants takes a long time to get them up and running. Are you looking to, what kind of timeline do you have in mind to get into production? Are you looking 10 plus years down the line to get into new builds, or is the market currently there with current installed capacity of nuclear power for you to get online much sooner than that?
The market is absolutely there for the uranium from installed capacity. As I mentioned, there's a very significant deficit already. And the two sources of supply that have filled that deficit being excess commercial inventories and secondary supply, both of those supply sources are under real pressure.
Okay.
Commercial inventories have normalized to levels where utilities don't want to destock the uranium that they've built up. They're probably more likely to start restocking. And the sources of secondary supply, in particular a source that's called underfeeding, have, at least from the Western world, all but disappeared now. So the demand's definitely there. where our project becomes particularly attractive is to utilities who've got existing nuclear power, plus they're also planning on developing reactors in the future. And for a reactor that has just been conceptualized, then 10 years is probably about right in terms of how long it would take to come on board, because you'd have to start from scratch with permitting, site selection. That's, let's call that 5 years, and then about a 5-year build, which is what reactors today are being built at now that they've had the opportunity to go through first of a kind build times. So for a utility such as that, having us coming on with new production in circa 2026, that's very important to them. It's, first of all, it's a lot of pounds that we'll produce, but it's also commercial and geographic diversity in a market that's become very, very concentrated. It's dominated by 3 players, only one of which is a truly public company. The other 2 have got very strong links with government. So the utilities want the diversity. They want to have different options. They want commercial competition to increase. And so we anticipate that they would be very encouraging of us, not only from a price point of view, but also in the way that they would be prepared to write long-term contracts.
Okay, excellent. Well, thank you very much for that and giving a bit of an idea of that 2026 for production. Certainly sounds and looks like on paper that there's a compelling project here that's going to last a very long time. Obviously, it's only the one project in the company's portfolio. That's all it needs to be. If it's something like this, it can keep investors and everyone happy for quite a long time. You mentioned, just quickly, I know I'm asking lots of questions, but 3 players there. Are you looking to be another player in this space then, or do you think that perhaps one of those big players will come and take you out?
We want to bring this mine into production in our own right.
Right.
We want to compete with those 3 players. Now, they're 3 very large players. They're not the only players. However, at £3.5 million, we will be a substantial player in our own right. Now, we are listed on the ASX, so I can't tell you that we won't be taken over or we won't merge and so on. Sure. That's the right of the market to determine that at the appropriate time. But our plan is to bring this project into production, and that's why I'm in Windhoek, Namibia at the moment. So I've been spending the last couple of days talking to Ministry of Mines, I'm meeting with Ministry of Environment, bringing them along with the journey. We've got the DFS out. Now we're talking about the go forward. Lots of meetings over here talking about how we start building up our HR component, how we're working with the engineers. We made a decision to raise enough money earlier this year to equity fund the front-end engineering and design. So, that's a very strong statement of intent that we are gearing up to build this mine and become a producer of uranium into this sector. As you pointed out, there might be consolidation, but we want to be in the absolute best, strongest position to drive that consolidation rather than be a recipient of a deal that doesn't achieve the best shareholder value.
Excellent. Well, thank you very much for your time today, Brandon Munro, the CEO of Bannerman Energy, and it's good to hear you are in country, starting those initial discussions there with the various government agencies, and work on the ground can start, as soon as possible, I guess.
As soon as the market's ready. So we've been at this project for 15 years. One thing that we know is that the uranium market has got great potential, but we don't know the timing of that potential. So we're telling shareholders that we're not going to back ourselves into a corner on a particular timeframe that we will deliver to. We're now in a position to come into the sector when the market's ready for us. And by being an advanced project and progressing that engineering with equity funding, we're then in a position to deliver into the enhanced uranium market and achieve the sort of prices that we've been talking about.
Excellent. Well, thank you very much for your time, Brandon Munro, the CEO of Bannerman Energy.
Thank you, Mark.